Rates on your screen Wednesday morning, middle of the week, just no interest whatsoever in any of the large or mid cap stocks. The breadth is absolutely anemic. Flat start with a downward bias, and this has just been the story. One day up, one day down, one step forward, one step back, one step forward, one step back, two steps forward, two steps back. Pretty much jumping in the same plane, the same place. Nothing very large which you want to point out. Let's look at some PSU banks because that's where the deceleration in terms of the price decline has started, whether it's BOB, Can Bank, State Bank of India, UCO Bank. It's just like, the zing is out in some of those stocks now. They are no longer the chased after high momentum names. UCO Bank is down 40%, approximately 40% from its high. You got SBI, which has turned completely. Canara Bank, BOB, none of these stocks are showing any signs of excitement. And there you go, first 50 seconds and the breath is already negative. So the inclination to buy is just not there, NMDC Steel, that's a new listing, but that's about it. You want to look at Zomato, Policy Fintech, Paytm, that's the only pocket of some buzzing momentum, but barring that, it's a dull market with a downward bias.
Right. Let's see, BEL, they've signed an MOU with ADA DRDO for Advanced Medium Combat Aircraft Program. I want to see what Gokuldas Exports as well as Welspun India are up to because, after that profit warning really coming in from both Home Depot as well as Walmart, and given that these are big suppliers to them, not really seeing a much of a material impact as of now. Prestige Estates then, the management is now aiming to double their overall residential sales by FY26. Mirza International, they've got the NCLT nod for scheme of arrangement for RTS Fashions as well as Red Tape. Delivery, the Visho December quarter volumes are better than estimated. They form, remember, 20 to 25% of their FY22 overall volumes. Metals, iron ore prices and steel prices are now at a 7-month high. Copper prices have seen an uptick of 1% overnight. So just marginally in the green really for the metals pack as well. Let's see whether the PSB decline is continuing today as well. Everything from an SBI to a BOB, Canara Bank, all these stocks were big losers. That softness on this entire pack continues today as well. And then, of course, the one space that held out yesterday was power and power ancillaries. So NTPC, IEX, let's just bring up all these names and show you whether or not they're holding out today. Tata Power is in the red, marginally soft for NTPC.
It's a flat start at best for the markets. Let's find out the first trades from our chartists. And Kunal, what are you punching in?
So it would be a sell on Bandhan Bank. The stock is now nearing a breakout of a major support. 225 is the major support for the stock. So would look to sell the stock at current levels. 234 approximately could be a stop loss for the trade.
Right, Nooresh, quiet on the index once again with a negative bias. Any stocks that you're punching trades on?
So a buy on IEX, which I continue to like, so closer to 140 to 143, looking out for a buy in this one.
Okay. Let's connect with Vetri Subramaniam. Let's understand what he makes of the current macro and the micro setup and how essentially one should be investing in this kind of a scenario. Vetri, it's been a year where news has been rather dynamic. The market has seen a complete contagion impact of the Adani sell-off, and the news on the macro front, one day it's recession, one day it's inflation, is slightly confusing. Connect the dots for us. What are you watching? What is on your radar? How would you stitch the scenario?
Yeah, sure. Thanks for that. Good to talk here today on ET Now. I'll just step back because, the news flow is way too erratic. But if you think about what's been happening since, early 2022, we've seen this very sharp increase in interest rates, obviously led by the US Federal Reserve, but, banks, central banks across the world, be it Europe and of course, even in India, rates started to move up very, very sharply. I think the initial response to these rates moving up was felt predominantly by equities. Of course, it was also felt by bonds. But in equities, stocks really responded to higher cost of money with, the high growth, high PE stocks starting to, obviously come under pressure as the valuations get taken down, adjusting for a higher cost of capital. But I think where you've sort of now reached the point in early 2023 is where we now have to worry about what do these higher rates and what are the intentions of central banks in terms of hiking rates. The intention is clearly to slow down the economy, to cool down the economy, to fight inflation. And that at some level obviously means slower growth. You look at India, we've got slowing growth compared to last year based on the forecast from government. You look at US as well. I know the economy has been slightly stronger than what people anticipated, but the US Federal Reserve is simultaneously arguing that we'll meet every sign of strength in the economy by keeping things tight perhaps for longer in an attempt to slow things down and get inflation back to trajectory. Now, when you've got all economies slowing down, you've got to start worrying about the second leg of what it means, which is not only asset prices getting hit by interest rates, but real growth and earnings starting to get hit by much tighter monetary policies, and in countries like India, much more disciplined fiscal policy as well. If you look at the March 23 earnings estimates, Nikunj, over the last 6 months, they've already come down by about 5 to 6%. We've now got just high single-digit earnings growth forecast for March 23. But if you look at the Bloomberg consensus numbers for March 24, it's been almost unchanged for the last 6 to 8 months, which is slightly mystifying, because if you've got these visible signs of growth coming down, then it's a little hard for me to believe that FY 24 earnings estimates will remain unchanged. So I think we are in the second leg of what started in early 22, where we have to worry about what it means for earnings growth, and there's a risk to earnings estimates from everything that's happening. The third element is really one of risk to financial system. We saw a little bit of that, if you recollect, a few months ago, particularly in UK, where the bond market really sort of panicked. But I think, perhaps at this point of time, I would rate that risk to be very low. In India, we have certainly got a very strong financial system, the best that I can think of in almost 15, 20 years. And in the US as well, most signs are that the financial system is very strong. So if there are problems, I expect them to be more Europe-centric and perhaps even Japan, because the yen for long has been a favorite funding currency. So, those are the three legs in which to think about the market: derating of asset prices, risk to earnings, and financial risk.
What is your understanding about the domino effect Adani Group of companies could have on the market per se, and also on the lending system per se? It's not a specific question on Adani Group of stocks, but the domino effect it could have.
Interesting question, Nikunj. Yeah, I won't comment on the group or the stocks, but just to point out that, I think foreigners have been investing in India for, nearly 30 years. At the best of my memory, in 1992 is when they started, and they have seen all kinds of events in India, right? I mean, for every company that went down, and I won't take their names, but the companies where we had accounting scandals, where we had, scandals relating to settlements at stock exchanges. Then that ricocheted into the fact that companies were also connected to that. And some very high-flying companies through the 90s, through the 2000s, and even the early 2000s, then met their comeuppance. And then we saw another round of companies which again went through a very difficult period. Many of them ended up in IBC and transfer of ownership after the GFC. So, bad corporate governance and good corporate governance exist everywhere in the world. I would, really point at this time to say that I'm not saying somebody is good or bad. All I'm saying is that sophisticated investors know about the risk they are dealing in the companies in which they are invested. And, they will not interpret market risk based on risk that may be talked about in some other enterprise. So I think I would not worry too much about this in terms of the fact that it changes the way foreign investors would look at investing in India. They've been doing it for 30 years. They've seen scandals come and go. And as I said, in this particular case, we still don't know what, the end result might be.
On a relative basis, Vetri, do you sense that the India underperformance, relatively albeit, to say markets like China or other EMs may continue for some more time?
That is possible. If you think about, I just break up the last 15 months into two periods. January 22 to October 22 is where markets like India, Indonesia, Brazil did very, very well. Markets like India, Indonesia, perhaps it's the structural story which held them up much better. But going somewhere into October 22, November 22, you actually saw some of the markets that had derated quite significantly, where cyclical pressures were the maximum. Those markets have got a bit of a leg up over the last 2 to 3 months. But I think the structural argument for India remains intact. But I think the bigger challenge for equities is really coming from the fact that for the first time in more than a decade, bonds are starting to figure in asset allocation plans of any asset allocator, be it a global asset allocator or an asset allocator sitting in any geography, right? This era of zero interest rates, negative interest rate yielding bonds is, I think, very clearly behind us. The entire interest rate curve has moved up. And I think what we are seeing at some level is the pressure where asset allocators are saying, okay, for the first time in a decade, I'm able to get a reasonable return on my fixed income instruments. And therefore, how should I think about my allocation to fixed income? For almost a decade, there was no alternative. You couldn't get anything in fixed income. So to my mind, there are two things we need to think about. It's not just about, is India attractive? It's that for the first time, asset allocators across the world are actually starting to find interest rates a reasonable alternative within their portfolio. And to my mind, that's creating a bit of a drag in terms of allocations to equities in general. The flip-flopping of cyclical moves will keep happening, but I think there is a reasonably strong undertone in the way foreign investors and certainly domestic investors look at India and its structural prospects. And I don't see that changing anytime soon.
Vetri, hi, morning. What about the outlook when it comes to the capital goods sector? Because no doubt we've seen consistency in terms of their financials. We have seen as well that their order books have been growing. But then there's that challenge as now valuations have become expensive.
Well, that's a fabulous question. You put the context across perfectly. I'll just, make 2 points here. One is, to my mind, corporate balance sheets very healthy. So, entrepreneurs' willingness to invest should be good. Capacity utilization has moved up. I don't think it's still at the level where entrepreneurs are, stretching or realizing that their plants can't move, can't raise output any further from existing plants, and therefore they really need to put capex in the ground today. And B, remember that the global growth environment is still slightly, hesitant. We are seeing whatever is happening across the world. So to sum it up, I don't think entrepreneurs have very strong animal spirits at this point of time in terms of ramping up capex, simply because everything that's going around the world is holding back those animal spirits. And the final point which you made is very relevant. Industrial stocks have surprised me by how well they've done over the last 12 to 15 months. I wouldn't have expected this if we'd had this conversation a year and a half ago. But I think at these starting valuations, it becomes very difficult for me to take a long-term constructive view, because I think a lot of the potential is in the price. And I do think there is still a problem as regards the animal spirits of entrepreneurs and their willingness to invest.
Vetri, good to have you as always. Thanks much for joining in.
Thank you.
Hello and welcome to our new show, a brand new show on ET Now, the class of 21. Well, we're calling it the class of 21 because in last 18 months, a lot has changed for the entire Indian public space. New tech and new consumer tech companies have gone public. Same time last year, there was a tinge of a euphoria. Couple of months ago, there was a lot of fear. But now optimism, hope, reality is coming back for some of the consumer and fintech stocks. So to understand the way forward for PB Fintech, or popularly known as Policy Bazaar, it gives me great pleasure to bring on board Yashish Daya, the co-founder of PB Fintech or Policy Bazaar. PB Fintech or Policy Bazaar?
Whatever you want to call it, yeah. But PB Fintech is the legal name.
Yeah. Same time last year when you went public, there was a little bit of euphoria. There was a tinge of excitement, and 4 weeks ago there was a lot of fear. But do you think now things are settled? Markets have understood the real growth and the terminology and the ideology of some of the consumer tech and fintech companies?
I don't know. I can't really comment on that. I think, no, not really, is my honest opinion. I'm not talking about share prices, etc. I'm just talking about the profit capability of these businesses. See, in the past, if you were putting up a steel plant, when you put up the steel plant, you would have capital expenditure, right? And then when the steel plant started operating, it would make profits. When you talk about these businesses, I'm not talking about these businesses, I'm talking about Policy Bazaar and PB Fintech. There's a huge investment in brand, in the platform, in the basic product, and that has flown through in the P&L. So what would otherwise have been capitalized? So what one is saying is, actually there is no value to my brand. There is no value to being Policy Bazaar, to having this huge amount of direct traffic coming in, and for the platform to have been built. There is no value to that, is what one is saying, if one is only looking at the profit. Because what's happening is, what would typically be a capital expense is actually flowing through your P&L. So if you look at our depreciation, it's negligible. And so the interesting part is, once these turn profitable, your entire capitalization has already been paid for.
So true.
And from there onwards, essentially the return starts. And I think one gets the story, right? And I think that is the big piece that I think the markets have still not understood in great depth. That what does this mean 5 years out? What does this mean 7, 10 years out, as these brands start to become stronger and stronger?
You are new to Bombay, so you must try the vada pav here. I can, assure you the vada pav from this place. It is something which is really gives you the flavor of the Mumbai city. Have you had vada pav in the past?
Of course I have.
Yeah. You've lived in Bombay?
I have lived in Bombay, lived and worked in Bombay.
Oh, okay.
For a company called IDW Signode back in 1998 to 2000.
Okay, so vada pav is not new to your palate.
No, not at all.
I can guarantee you this place, in a sense, as one of the most delicious vada pav. It's very close to our office, so it's always one of the places where we hop across to.
Okay.
Please try. In last 12, 18 months, again, the environment at a macro level has changed. Interest rates
have gone up, yeah.
It's not easy to raise cash now. The way growth companies are going to be valued, it's also very different.
Yes.
So what has been the realization for you per se?
See, my view is, and I remember this from a conversation well before I started Policy Bazaar. I was at one of these, and I think it was the guy who built Games to Win or something of that sort. And he was saying that, look, I have seen the cycles. There are cycles when markets go very buoyant, and there are cycles when markets go sort of very negative. So these are the cycles. Interest rates going up, interest rates going down, etc., etc. I don't know what the future holds. If somebody does, rather than telling the world, they should be taking advantage of it.
But your stake at the beginning of the IPO when you went public was 5%, it is still at 5%.
It's a little, my stake has increased and will hopefully increase further by about 1% since the point when we went public till now.
So why will your stake increase?
Because we had ESOPs, which when you get the ESOPs, you exercise them and your stake goes up. And when you exercise them, you also have to pay taxes.
Thank you.
So for that, you have to sell some shares. That is how it is for most people.
Has the public market forced you to rethink any of your strategies? The general mantra for a consumer tech or a fintech company was growth. And the more you grow, the more you are valued. That was the matrix which was used by PE investors.
Yeah.
But has the stock market or the public market compulsion forced you to rethink your growth strategy?
So one of my frustrations is that the public market will claim that it has forced us to rethink our strategy, while our strategy has not changed at all.
Or is it?
At all.
Okay.
It is exactly what we were going to do, is what we are doing. Nothing has changed. But my frustration is that we will not be given credit of that in the end, because the market will spin its own story. And so the market will, or the media will spin its own story. And the story that fits the narrative right now is that the public markets have forced the companies to go towards profits. We have done nothing new. Our business is exactly what it was. Nothing has changed.
But your expansion, maybe expenditure in terms of the new businesses which you are incubating, the employee hiring, all that has not changed because of public market compulsion.
Let me actually explain. It was after the focus on profitability in the public markets that we started a lot of our new initiatives.
Okay.
Which did not exist. So in 2021, we did not have anything called new initiatives. This year, I'll be making almost 250 crores of losses on new initiatives, which did not exist at the point of the public markets euphoria. So all I'm saying is, maybe we're different, maybe we're out of step with the market. Yes, our new initiative costs have been coming down, but that's exactly what was planned to happen, because they went up and they came down. It wasn't that we're doing anything different. And I think I would love for people to appreciate reality for what it is, rather than, spinning their own narratives and putting everybody in the same bucket.
SoftBank has sold half its stake.
Yes.
Tencent has about 9% stake.
About 5%.
About 5% stake.
Yes.
Okay, I stand corrected on that one. Are you getting a sense that more and more anchor investors are looking at reducing their stake?
I wouldn't have a clue.
So they did not approach you when they were selling in the public market?
I can tell you very candidly the conversation I had. I had a call with all the anchor investors 1 day or 2 days before the lockup. And I told them I'm very, very grateful for all your guys' support. The company is strong, does not need your support at all. Do whatever you have to. And don't at any point believe that you owe the company something. And for that you have to hold on or sell or whatever. Whatever else anybody tells you, I'm telling you this straight from my mouth. It was a 5 to 10 minute call and that was it. And I don't think I have spoken to any one of them. Don't know. I can confirm I have never spoken to any one of them about whether they are buying or selling or what they are doing. That's their choice.
You have 90% market share of the online market broadly.
Of the aggregator market or the distributor market.
Distributor market. Broadly 90%.
Yeah.
You're growing at 30%.
Our premium is growing at 70%, but yes, our new business is growing at 30%.
30%, right?
Yeah.
Which makes it almost 3x than that of the industry average.
Sure.
This business itself is a growing business and your core business is now making money. So what is the need for you to expand? And what is the need for you to incubate businesses which initially will be eating into capital?
We started the new initiatives because we thought it was very important to do those activities. We started the the POSP business. It can give you very rapid scale. It helps our relationships with suppliers. See, insurance is not a mechanism by which you only do things one way. You can do the sales in multiple ways. And that helps you build your partnerships with suppliers because they are looking at the overall volume. So that was the primary reason. And it's a decent business. We think it's going to make good money in the future. But the scale advantage it gives you on your overall business is phenomenal.
Okay, I think I'm holding you back from
No.
enjoying the food. So I'm just going to nibble a bit here. As per the last reported data, and if I take the ESOP charges away, you're actually making money, which means there's no cash burn.
Yeah.
And you've given a guidance that you will be positive, which is profitable, in FY24.
Yes.
Define that for us. First half, second half, first quarter, second quarter.
No, full year. When we finish March 24, because see, we are a seasonal business, so you have some seasonality, etc. When we finish March 24, overall for that thing, we would be PAT positive, is my estimate.
What would challenge your estimate?
Not too much. And I'll tell you why. See, in our first year, we had ESOP charges of about 700 crores. Those will be down to 300 automatically. So that is a delta. We have 5,000 crores of cash that generates interest income. We have a renewals business which generates about 300 crores of revenue. It should generate about 450 crores next year. So, and that is a very high margin business. So all of this put together pretty much guarantees it. See, if anybody noticed, last quarter we did make 87 crore loss, but our ESOP charges were 111 crores.
Over 100 crores.
Yeah. So the moment you take that out, we were, from a cash perspective, we have been not burning cash for a while. Our cash balance was the same at IPO as it is today. And that's why I'm saying I think what I was trying to tell the market is that yes, you're seeing losses, but those losses are ESOP charges, which are an
That's
accounting
not operating loss.
which is an accounting charge, because the ESOP charges are for 5 years. You're giving the same amount of ESOP every year, but in the first year you're charging 700 crores, in the last year you're charging 40 crores for the same amount of ESOP every year. So that is just a delta of 660 crores that comes just from the ESOP charges.
So when you say a number of 1,000 crore for FY27, how are you deriving at that number?
See, if anybody does the mathematics, our renewal revenue keeps growing. Our new initiative losses are coming down, and it is expected by 27 they would break even. So they'll be at zero. Our core business, is already positive. It's already made 100 crores of positive EBITDA this year. And the ESOP part is going to disappear, because that is a notional charge which you're seeing right now, but that will not be there after 5 years. You put all of that together, and there is no way you will come out with a different number. It's not my number or your number. It is about just understanding how the renewal, and please appreciate, I'm not even building business growth into it.
What is the business growth according to you?
Broadly about 30% on fresh business, roughly about double the rate of the industry is what I would say.
But if I speak to manufacturers, both private manufacturers and even LIC, they're not very happy about growth. In fact, all of them are still recovering from the COVID jhatka. They are, in a sense, clear that the long-term picture for insurance is great, but in the near term, maybe it's the pricing or maybe it's the growth base. They've gone through a rough patch. So if the manufacturers are complaining about the growth, why would a distributor be growing?
See, I'm not going to comment on manufacturers, etc., and what they, and I won't even know. See, I'm focused on a very, very basic problem. This is the middle class in India. Families earning between 5 lakh rupees to 25 lakh rupees have a lot of difficulty if they fall sick, or if the earning member dies or gets disabled.
You must try the Golgappas, yes sir.
Yeah.
Golgappas are...
So, very serious problem for which we don't have a mechanism. Earlier, the mechanism was the joint family system. But the joint family system is going away. And the same problem exists at the pension end also, which by the way is as big a problem. These problems, if you focus on them, the problems are there and you have to solve them. The solution comes from education, it comes from making sure the claim support is good, all those pieces, making sure you have a good platform where the consumers can transact. I think as long as you're focused on that, I don't think growth can elude you. I think as an industry, we do a lot of things, not just the protection element. And I think maybe that's why we sometimes have compulsions one way or the other.
Now, the minute I say Policy Bazaar, the recall is insurance and protection. But you also have a credit business, and that's a sizable business now.
Yes.
But that's one business where competition is only increasing.
Yes.
By existing players, by fintech, and what, in a sense, Reliance is planning to build. What will be a competitive edge in the credit business?
See, we're a marketplace.
Yes.
So, and this is why people misunderstand. A lot of people think direct players are competition to us. They're not competition. Almost more than half of our sales come from direct players. Because as a direct player, where do I get volume from? I can get it from Google, I can get it from brand, or I can get it from marketplaces like Policy Bazaar and Paisa Bazaar. Now, for the consumer, what's the benefit? He wants a loan. He doesn't care who gives it to him. He wants to know, I want 5 lakh rupee loans for the next 3 years. Who will offer it to me fastest? At what interest rate? And for that, he comes to Policy Bazaar, Paisa Bazaar. Paisa Bazaar gives him a choice out of 100 odd partners. that, because every customer is a different segment. There's some people who are very well off. They will have pre-approved offers from the top banks. There are some people who cannot get a loan at all. And they would have, you're building a sustainable...
Some riders are there, yeah.
And no, you will almost have different kind of offers or very specialized lenders who would be lending to them. So building that entire marketplace and making it work in a commercially sensible way for the suppliers and for itself adds value to both the consumer and the suppliers. And so it has a place out there.
Because of each technology innovation, we've seen historically industries are getting challenged in terms of the total fee and the distribution structure.
Yeah.
Brokerage industry, zero brokerage, zero that came and disrupted the entire thing.
Yeah.
Mutual fund, direct versus distributor, direct industry is growing right now.
Yeah.
Now, the insurance industry is a fat margin industry. Can that get disrupted?
Of course. And why not? But right now, the cost of acquisition is very, very high. So I'll give you an example. If an insurance company tried to use, let's say, Google to acquire customers, its cost of acquisition is upwards of 100%.
Okay.
More than 100%.
More
More than the premium.
year.
More than the premium.
Okay. More than the premium.
More than the premium.
Okay.
I'm not talking about 100% of revenue.
Yeah.
So someone like a Policybazaar is operating at 17-18%. So even if you were to pay for 5 years, it will take 5 years. Plus, if you do an NPV, we are at a 20% IRR on the NPV front. There's a lot of value of acquiring business from Policybazaar, and your brand also gets built. So we are able to give good volume business to somebody with brand accretion, right? The second thing we're able to do is get good declarations, so that your claims ratios stay under control. As long as you can bring customers to the table and you can get good quality business, which is the declarations part, you will largely stay, you'll be adding value to the insurance companies.
Fair point.
And as long as you're adding value, you have a play. The day an insurance company can actually acquire more efficiently than you, then yes, it should. Why not?
But
now,
you don't see that happening even with IRDA talking about a direct platform?
No, it will happen, and why not? And our own margins, we may see, take rates come down and all that stuff. I think that's just an evolution. All I have said is, all along, we are currently in the top decile of the most efficient ways to distribute insurance.
Okay.
If you're direct, you have to spend on Google, you have to put a call center. It is far more expensive than the Policybazaar mechanism, right? Some mechanisms do not allow you to have a good claims ratio. So when you look at the overall in a circumspect manner, it's a top decile area from an efficiency perspective. I think usually the bottom decile should worry, not the top decile. And there is no reason why the top decile will not keep getting more and more efficient. Now, a lot of people confuse this with mutual funds or something else. My humble opinion is I think it's their, maybe they've not understood the industry enough. Out here, a customer does not buy. A customer has no gratification from buying an insurance policy.
Fair.
You buy a policy not to take a claim. You buy a policy to hope that in the case the worst happens, the claim is there. But you don't want to deal with the policy. Nobody wants to go to hospital to make a claim.
Yes.
Right? So I think it's a very, it's a difficult industry. And I think people have understood, if they are thinking in a similar manner, they've understood very little about it. Motor insurance is a different ball game. That is direct. Motor insurance, two-wheeler insurance, travel insurance. Why? It has a date by which you need to purchase.
Yes.
In term insurance, you don't purchase. What's the problem? Not today, not 6 months, not 6 years. You may never purchase.
It is not a compulsion, which is what makes
There's
it
no
very
compulsion. There's no compulsion.
different. You're sitting on 5,000 crores of cash. Now that's about 750 million dollar, depending on the dollar value we look at.
Yeah.
What is the need of such high cash? Some of your peers have announced a buyback. Would you consider thinking on those lines?
We have made no such decision so far. When we have a decision ever in the future, if we have, we will of course let the markets know, but there's no such decision
So
whatsoever.
5,000 crores is a lot of cash when you are confident that your businesses do not need capital to grow.
Let's see. I think we are at least till March 24. We want to just execute rather than focusing on other things. And I'm not saying it's bad to focus on other things. It's just we're not interested. We want to complete March 24, and maybe at March 24, reevaluate the situation.
You know, a lot of IT companies, for the longest time I've tracked them, let's say from 2000 to 2016, 17, they were sitting on a lot of cash, IT services. They called it strategic cash, and they never acquired anything large. So are you sitting on 5,000 crores strategic cash?
Nothing of that sort.
Nothing of that sort.
Nothing of that sort. See, we have had in the past marketing expenses, etc. We were in the past not making money. And now for the last 1.5 years, we're not losing money. And hopefully now we will start making money. So I think as we get into 23, 24, and the reason I mentioned that, I think there'll be a lot of positive cash inflow. See, we are on positive cash flow now. So I think next quarter you should see a lot more positive cash flow, and then next year a lot big. My assessment is we should have about 400 crores of positive cash flow next year. So as that starts to happen, then people, then you do start to ask the question that if you're on 400 crores positive cash flow and have 5,000 crores lying around, then what are you doing? And I think that question will become very loud by March 24, which is why I said, let's rest till March 24. Today we still have different metrics, EBITDA, adjusted EBITDA, etc., etc. Let's get rid of all of this. Let's get to full PAT. Let's get to positive cash flows of at least 100 crores a quarter, 400 crores a year. And we are just 4-5 quarters away. So let's just deliver that. And once we've delivered that, then let's reassess what should be our capital strategy. I think it's not time for strategy right now, right? It's time for just. I think my biggest difficulty is I think the market has not understood who Policy Bazaar is.
Yeah. That's the reason why we're having this meal over the lunch.
Yeah, and I think
I'm stopping you back again.
No, I've eaten enough. I don't eat so much. But I think once we achieve that, then we can focus on a few other items. But I think right now that gap exists.
Is there a number you're chasing for Policy Bazaar and for yourself? Gordon Gekko in the movie Wall Street once famously said that every man on Wall Street has a number. So what is Mr. Dahiya's number?
1,000 crore PAT in 27.
Will that make you happy?
That's my goal. That's my stated objective. That as I look at the next, 4 years, because we're at the end of 23 now, so 26, 27, that we should make 1,000 crore profit. I think it takes away the question that are you profitable? Is your business fundamentally profitable? That
All right, back with first trades and down about 140 points or 0.7% across the board, not just the frontliners. Adani Enterprises is down 7%, Adani Green, Total Gas and Transmission in the red. You've also got a whole host of other stocks within the Nifty 500 like Tata Investment, Aditya Birla Fashion, a Cochin Shipyard. Those are some of the other stocks along with Sonata Software and Uflex, by the way, that are buckling under pressure. But let's move right on then and connect with Sumit Deb. He's the CMD at NMDC, joining in to talk a little bit more about the demerger and what it means for shareholders, as well as the outlook on the industry as a whole. Thanks so much for taking time out, Mr. Deb. To begin with, NMDC Steel's demerger now has taken place. The listing is behind us. The next trigger is going to be the stake sale by the government in NMDC Steel, with them currently holding about 60.8% stake. What is the update on this front? Any timeline you can share?
No, not really. At this point of time, the disinvestment ministry, that is DIPAM, is running this disinvestment process. So it will take some time to actually get in the detailed information.
All right, and given that NMDC Steel's Nagarnar plant is under construction, it's likely to be commissioned only about a month or so. Is that on track, and what's your total capex over there?
So we started the coke oven batteries. That is the first phase of the steel plant. Coke oven battery 1 is what we have started in October, and that is fully functional now. Next is in line is the sinter plant, and then the battery 2, and then subsequently the blast furnace and the SMS. The total capex which has been spent on the steel plant should finally end up at 24,000 crores. Currently, we have spent almost 21, so another 3,000 crores to go.
Right. The lower average selling price and higher operating costs have clearly impacted your Q3 performance. But as global economic concerns tame, can we expect Q4 to be better?
Yes, definitely. In case of the iron ore industry, the fourth quarter is looking up. Prices are also looking up. Global prices have gone up. Steel prices have improved, and we would definitely see an improved performance in the fourth quarter.
Right. And average domestic iron ore prices, they've largely remained flat on a sequential basis, but metal prices have seen a rise yet again. Have raw material prices also risen in tandem, and could realizations also see an uptick in the coming quarters?
So Q1 and Q2 basically have been down. Prices were down, but then Q3 we have seen improvement in the prices of iron ore, and Q4 there has been a substantial improvement. The steel prices have also gone up, like I have mentioned, and we would see improved realization in the fourth quarter.
Back of the export duty in November, NMDC has taken multiple price hikes. Have the price hikes been absorbed? Is the demand strong enough now?
Yes, we are seeing a very strong demand in the market, and Q4 is normally the business end of the year, and most of the companies are pushing production. So we have seen a huge pull in the demand.
Given that globally as well prices have risen, are there more price hikes on the anvil? Could you quantify that for us?
Going forward, yes, we are looking at the current scenario and the steel prices also. We are including the global prices. I think that is not ruled out.
And post the export duty rollback, are iron ore exports now more favorable than the domestic sale? Is the company looking to ramp up their export sales now?
Yes, we are seriously looking at exports also for lower grade of iron ore. But then that will come only after the domestic demand is met. However, exports remain a priority, especially in the Karnataka sector. We would intend to do some exports also, and accordingly, we are looking at the various options.
Right, and given that NMDC Steel has now been demerged, any capex towards steel plant that's not going to affect NMDC's balance sheet, because you do not have any major capex lined up either. So should investors expect say a higher dividend?
As far as capex goes, yes, we have substantial capex lined up in terms of our slurry pipeline, the pellet plant. So all these will and the beneficiation plant, which are already in progress at this point of time. So that will involve some capex in this financial year. Obviously, dividend is something which we have always given, and generous dividend has always been there. So that's always there on the cards.
Appreciate your time. Thank you so much, Mr. Deb, for joining in and giving us the roadmap for NMDC Steel post that demerger. Moving right on then, given that it's a lackluster market at hand, the fact that we are in a range, the question is, when are we going to break out of this range? And if we break out, which side of the range will we come out on? Let's recap that conversation with Nikunj and Kunal Bothra explaining the thesis.
We are in a range. We will be in a range, but we will not be in a range for an extended period of time. And that is what I think the last 2 year history has told us, that it's not for the first time, Kunal, and I'm not talking about data which is once upon a time. This data is only limited to last 2 years, or 2.5 years, when we were in a vibrant bull market.
Absolutely.
In a vibrant bull market also, ranges have happened in the past.
Absolutely.
So there is nothing to feel sad, worried, unhappy, or dismissive about it.
Well, absolutely right, Nikunj. You've hit the nail on the head.
Absolutely 3 times.
You've hit the nail on the head, because the range is also 3 times what we are discussing. So, in every kind of a market trend, there's a theoretical assumption that out of 12 months, we said that the markets trend for 3 to 4 months, and the remaining 6 to 7 months, the markets broadly remain to a narrow kind of a tight range. So even the data over here alludes something very similar. Even in the vibrant bull markets of 2020 second half, 21, 22 first half, there was good amount of evidence that the markets went to a range. This is the classical point. So what we've taken as an assumption is that the markets remain to a range for 3 months period, and the range is broadly 3% to 2% plus or minus the median point for the index.
How different is this range or this current period patch of the market from the previous periods we've analyzed?
So again, very good point. The three comparisons which we've done, the 3 points where the Nifty has entered into a range is completely different.
Okay.
So for example, the first one, which was the March and the May period of 2021, the Nifty entered into a very strong uptrend. We consolidated and then we broke out immediately post a 2-month, 3-month consolidation. The second was in the month of June, July 2021. Again, a period where the markets remained to a range. This time you won't believe the range was just 350 points, 2% on the Nifty, and we spent more than 3 months remaining to a very tight band. Again, we broke out immediately on the upside. The third one was intriguing because we managed to rise up higher. We spent some time consolidating. We fell first immediately, and then we resurrected and we managed to come back towards 18,000 mark. So the 3 historical references are completely different than this time around, because here we have gone to a range falling by more than 1,000 points first.
So just to wrap it up, Kunal, now you will not be in this range permanently.
Correct.
What we are trying to perhaps analyze for our viewers is that what would be the eventual, which side of the range you will come out? Because if you will come out with a downward bias, then I think the downside will get only amplified and multiplied. If you come on the upside, then the automatic upside, once you come out of this range, whenever we do, I think automatically would be strong. Based on your analysis, do you think what are the, on a scale of 1 to 10, what are the chances that this will be a breakout range or it will break down?
So the chances are very much high, looking at the historical comparison, that the breakout should be on the upside.
Upside. Okay, so you are making a
yeah, in fact, this data over here suggests very similar.
Okay, let's walk through the data, and I think this is the sum and summary, if you frankly ask me, of what we're trying to bring out. It is not for the first time this market has seen a range. The best of the bull market, which is the 2021 and 2022 bull market, where everything went up like a bazooka, it was almost like a V-shaped rally, saw 3 ranges.
Okay, in the meantime, Railways may soon announce rationalization of freight rates for shorter distances and make warehouses at strategic locations for easy movement of freight. ET now has learned from sources that these are other issues which were discussed in a meeting of cement industry with Railway Minister Ashwini Vaishnaw recently. Samir Dikshit joins us right now and he's picking up these exclusive details. Samir?
Railways has set an ambitious target under the Mission 2025. The target is that by year 2025, Railways will achieve a freight movement of 3,000 metric ton. And in the same direction, Railway Minister Ashwini Vaishnaw chaired an important meeting with the industry players of the cement sector, cement manufacturers. They were the part of this meeting, and the larger message that was conveyed is that now the government is reaching up to the private players, and they are requesting that if you come up with a long-term contract, if you give an assured volume, then all the problems or whatever the obstacles the industry is facing, that will be removed, overcome by the Indian Railways. Now, a couple of assurances that was given by the minister in this important meeting, and that has been informed by the sources, is that PM Gati Shakti Multimodal Logistics Center will be set up. For the same, tenders have been floated and more tenders will be floated in the upcoming time. Another assurance was that at the strategic centers across the country, these storehouses or the warehouses will be set up for the cement industry for the easy movement of the cement through the rail transport. In addition to this, we have seen in the past that a considerable chunk has been lost to the road sector, especially in short distances, which is less than 500 kilometers. So now Railways is looking to rationalize the freight rate so that these short distances freight movement, or specifically the cement movement, can be brought back to the railway sector. So these are a couple of assurances that has been conveyed, but the bigger part is that the cement industry has been asked that you have to come on board and you have to come up with a long-term contract with the railways, and rest assured that whatever the problems are, like the availability of wagons, building up new railway line for a easy and time-bound freight movement of cement. So these all will be done and taken care of by Indian Railways. An important meeting was chaired by the Railway Minister, and now it is up to the cement sector or the industry players that how they respond to the call given by the Railway Minister.
All right, it's time for a quick break right here on the show. Be right back with news that the index is at 17,689.